Alright, welcome back. Lesson 5 Institutional and Macro Glossary, aka Dictionary. Okay, so why language equals power? So, to navigate macroeconomics, you must speak its code. The elite don't use plain words, so to speak, they use controlled vocabulary that shapes how money moves. So each phrase in a central bank statement is engineered to signal liquidity direction without saying it directly. Okay? Why you think all the government officials, central bank officials, etc., when they go and do the press release, they always have a speech written for you? It's not because it's formal, it's because they have to say what they have to say in a very specific manner. Because if the Fed basically cuts the rates, the guy can come in a tracksuit and be like, "Good evening, we are cutting the rates." That's it. And he can leave, right? But because it's a pretty secretive game, so to speak, they're saying everything in an engineer-specific manner, so it hints the next directional moves. And that's why always the market moves pretty much milliseconds before the actual words, because they are following behind the lines. Okay, so when you understand the words, you no longer react to headlines, you read the map behind the curtain. Okay, so let's begin. The foundations, the money layers. So let's start with how the money is defined in the real financial world. First of all, you might see two letters, MB, or the words monetary base. This is the sum of currency in circulation plus the bank reserves held at a central bank. It's the foundation. Central banks expand or shrink this base via open market operations, either buying or selling assets, right? Now, M1. M1 is cash plus checking deposits. M2 is M1 plus savings accounts plus short-term time deposits. And M3 is M2 plus large time deposits, institutional money markets, and other large liquidity forms. Usually M3 is no longer published by some central banks, including the Fed. Alright, so the most popular chart when you want to look at a money supply is M2. Okay, so when M2 rises rapidly, it usually signals the credit expansion and future inflation. Okay, and you can do that simply by looking at the M2 supply chart on TradingView, on multiple statistical websites, Trading Economics, the actual central bank itself page, all of that stuff. This is an example of M2 money stock from the Fed, and as you can see, it's a pretty straightforward thing, right? It's a pretty straightforward, and as you can see, precisely towards 2020, 2021, we had a bit of a decline, so to speak, a slight pullback, so to speak, on the money supply, and it's now expanding once again. So they are printing the money, meaning that the money is being injected into the system. While this is happening, assets will go up no matter what short-term charts are showing you. Okay, moving forward, central banks jargon, so to speak. So what each of these words mean. Yield curve. You probably saw that before when reading some sort of financial statements, blah, blah, blah. Yield curve is simply, it shows interest rates across the bond maturities. So when the short-term yields exceed long-term ones, okay, the curve inverts. And this is a classical recession signal. Yield curve control. This is a policy used by Bank of Japan. So it's basically to fix the long-term rates by buying bonds, indefinitely. It's liquidity engineering through force. Okay, risk premium. This is the extra yield investors demand to take on risk versus safe assets. So when liquidity is high, risk premiums shrink. So people chase returns, right? When liquidity tightens, risk premiums expand. So the fair returns, so to speak. The credit squeeze is when lending slows because banks tighten standards or lack reserves. This precedes recessions and liquidity crises like the ones in 2008 and a recent one in 2020. Macroprudential policy. Regulations meant to reduce systemic risk like capital buffers or leverage ratios. It is how central banks indirectly control asset bubbles without touching the actual rates. Okay? They have all the tools possible, everything we can imagine, they have a tool for it. So, forward guidance is a verbal hint about the future policy. Words like accommodative, neutral, or tightening bias move trillions before action even happen. Okay, so you have to read behind the lines. Moving forward, decoding the vocabulary of power. So let's decode what policymakers really mean when they actually speak. Accommodative policy means the rates will stay low, liquidity will flow, right? The tightening bias, expect higher rates or reduced balance sheet soon, okay? So the assets prices will go down. Data dependent means that we are waiting for a good excuse to do what we already decided. Okay, data dependent. Fed is using this all the time. Financial stability tools. These are the new interventions coming without calling them bailouts, so to speak. Transmission mechanisms or mechanism. How central bank decisions affect real-world lending and prices. Excess liquidity absorption. They are pulling money from the markets quietly. Liquidity facilities. Temporary credit lines that often become permanent. So they will start it as a liquidity facility, so to speak, for a short-term credit line, but it usually becomes permanent and it just keeps on going. So each phrase is carefully designed to sound neutral so you don't understand it, but it actually moves the markets. And there are certain algos that are following this very precisely, every single little sentence and tone on how they are speaking. So how to use this in practice? Well, basically, when a central bank statement drops, you want to, first of all, ignore adjectives and track on verbs. Will continue, stand ready, reduce purchases. These are the signals. Okay? Don't focus on the actual adjective, focus on the verb. Then match words to tools. So balance sheet normalization. Sounds pretty neutral, but it's actually the quantitative tightening policy. So they will be shrinking the balance sheet, selling the assets, so to speak. Liquidity support immediately means either the easing conditions or the repo injection. So they will inject liquidity into the system because liquidity support, they will support the market through liquidity. Watch for tone drift as well, from accommodative to neutral to restrictive, these words. That's how tightening cycles are announced without a shock, meeting after meeting. At first it's accommodative, then it's fairly neutral, and then it's we're gonna go fairly restrictive, so to speak. And then you want to be combining everything with the actual data, what they are speaking and what is the data showing. CPI, Consumer Price Index, employment, NFP data, non-farm payrolls, the growth, GDP, and credit M2 supply. If policy words and data diverge, trust the data, not the narrative. Okay? So the power of slow speech, just to close it up. Okay, this is a short, simple lesson. Many central bank terms are intentionally imprecise. Accommodative stance, quantitative tools, temporary measures. They sound technical, but they actually hide the speed and volume of capital movement. It is by design. It gives central banks strategic positioning, letting them move quietly while everyone debates semantics. So once you learn their code, you see the real story before it hits the headlines. By mastering this very simple beginner glossary and dictionary, you will read between the lines like a macro fund manager, so to speak. So when you see a sentence like the ECB, European Central Bank, maintains a data-dependent, flexible stance in response to evolving inflationary pressures, then blah blah blah, something continuous. This basically translates to they are uncertain, the quantitative tightening, right, is paused, and liquidity might return if data worsens, right? So they hints about possible easing. The QT is now paused, but they are still data dependent, but they have a flexible stance in response to evolving inflationary pressures. Okay, so they might need to step in and return the liquidity, but not at the current moment, but they are suggesting that. So then you move to the data, you follow the data, what kind of data you are seeing, the numbers, right? The most important numbers, and we will talk about them in the future. So basically that's how you are reading those statements, not like as a book, as a sentence. Oh, the ECB maintains a data-dependent flexible stance, blah, 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 and you have no idea what it means. You read it from behind the lines, okay? So when liquidity returns, risk assets rally, especially crypto. And when our liquidity shrinks, crypto and all the rest of the markets, the risk on markets, stocks and crypto mostly these days will shrink, while safe haven assets will most likely increase. Okay, so that's how these things are engineered, and these are the basic terms that you should master. And now your job is to go to the central bank statements and actually find the words and actually do it and do a little research and analysis what they are suggesting and what kind of words they are using. Okay, for this you can even use AI, especially Perplexity. This would be my recommendation. Upload central bank speech to Perplexity and ask Perplexity to find all the hidden meanings behind the lines supporting or rejecting the monetary policy decision to easing or tightening, right? Do this and you will start learning what kind of sentences means what kind of things, and this will help you to identify those things in the future. Okay, so thank you once again for watching this. Hopefully it's going to be beneficial as it was for me when I was learning these things. And of course, as always, I will see you on the next lesson.